Layer 1 is the risk the household cannot absorb by itself. This usually includes the death or disability of a primary earner, major medical costs, long-term care needs, a mortgage that cannot be serviced, or basic living and education expenses that would be interrupted. The test is not whether the event sounds scary. The test is whether the household would be forced to borrow at a bad time, sell assets under pressure, stop necessary spending, or move a care burden onto someone who is not prepared. When the loss is larger than the family can realistically absorb, insurance is doing its clearest job. Layer 2 is the middle zone, where the family may retain part of the risk and transfer part of it. Hospital gaps, a few months of income interruption, liability from an accident, home repairs, and the first stage of family care needs can all create pressure without instantly destroying the whole plan. The right question is not, should I buy every rider? The better question is, how much can cash reserves, employer benefits, public systems, and existing policies cover, and how much gap remains? This layer often needs balance rather than maximum coverage. Layer 3 is the small risk that the household can usually absorb. Small outpatient bills, a repairable inconvenience, delayed travel, minor property losses, or a purchase that can simply wait may be better handled with cash flow and reserves. If every small inconvenience is wrapped in a policy, the premium can become a fixed burden. That burden may weaken the family's ability to fund emergency reserves or protect the truly large risks. Small risks are real, but the tool may be different. The first common mistake is looking only at the face amount and not at the responsibility period. The same amount of life cover means one thing for a parent with young children and a 20-year mortgage, and something very different for someone with independent children and no debt. Insurance is not automatically better because the number is larger. It should cover the period during which another person depends on your income, care, or balance sheet. As responsibilities decline, the structure may change. As responsibilities rise, the map should be checked again. The second mistake is mixing saving, investing, and protection until the job of the policy is unclear. Some people want the policy to come back with value, to act like an investment, and to protect the family at the same time. That may be appropriate in some cases, but it can also hide the basic protection question. If the job is to transfer a large risk, start with the coverage trigger, the period, the premium load, and the claims conditions. Do not let the promise of getting money back distract you from the risk that needs to be transferred. The third mistake is expecting one product to answer every question. Life insurance protects against the loss of income or a family responsibility after death. Medical cover addresses medical expense volatility. Critical illness or major disease cover may help with diagnosis, related income, and treatment pressure. Disability and long-term care cover address a long care cash flow problem. Liability cover deals with harm caused to another person. These are all called insurance, but they do not solve the same problem. The map prevents one product label from pretending to cover every layer. The fourth mistake is leaving premiums without a household limit. It should not crowd out basic savings, debt repayment, emergency reserves, and necessary living expenses. If premiums leave the family with no monthly surplus, then even a small shock becomes harder to handle. A practical process is to set a premium range the household can carry, then use that budget first for the risks that would break the plan. If money is limited, protect the highest severity gap before buying many smaller conveniences. The fifth mistake is reviewing policies person by person instead of looking at the household. Who earns the income? Who provides unpaid care? Who holds the mortgage? Which benefits disappear if someone changes jobs? Does the family know where policies are stored, who the beneficiary is, and what documents a claim would require? A list of policies is not the same as a family risk plan. The map should connect each policy to a real responsibility, a real person, and a real claim situation. To build the map, start with risks, not products. Draw 3 layers on paper. Put catastrophic risks at the top, shared or partial risks in the middle, and small retainable risks at the bottom. Beside each risk, write 3 numbers: the possible cost, the amount the family can absorb, and the remaining gap. Only after the gap is visible should the household compare policies. This changes the conversation from, should I buy another policy, to, which gap is still unhandled and which policy actually closes it. Next, set the protection order. When the budget is limited, first protect the people and responsibilities whose loss would hurt others. Then look at long-term care or disability situations that could drain cash flow for years. Then fill medical, liability, and middle layer gaps. Small overlapping benefits come last. Every family will have different details, but the principle is stable. Handle low-frequency, high-severity losses before high-frequency, low-severity inconveniences. The goal is to prevent one event from collapsing the household plan. But overlap becomes a problem when the same small risk is covered several times while a larger risk remains open. Put every existing policy onto the three-layer map. What layer does it serve? What premium does it require? When does the cover end? What condition must happen before a claim is paid? If a policy has no clear job and survives only because it was bought years ago, it belongs on a review list. Life stage matters. A single adult, a couple with a mortgage, a parent with young children, a business owner, a caregiver for aging parents, and someone approaching retirement all carry different risks. Early in life, the focus may be future income and family responsibilities. In middle age, mortgage, education, and care risks may overlap. Near retirement, the focus may shift toward health, long-term care, cash flow stability, and premium affordability. Insurance bought once is not automatically reasonable forever. Review it when the family changes. Emergency reserves and insurance should be read together. Cash reserves help during the waiting period before a claim, cover deductibles, absorb small losses, and handle temporary income gaps. Insurance helps when the loss is too large for the family balance sheet. If you have insurance but no cash, the first weeks of a problem can still become stressful. If you have cash but no transfer tool for a catastrophic risk, one event can consume years of savings. The three-layer map shows where self-insurance ends and risk transfer begins. Policy terms matter more than slogans. A benefit name can sound clear while the claim trigger is narrow. Waiting periods, exclusions, renewal conditions, premium increases, benefit periods, medical definitions, disability definitions, and coordination rules can all change the real value of a policy. A household does not need to become an insurance company, but it should know the main trigger and the main exclusions for every important policy. If the wording is unclear, ask a qualified professional to explain it in plain language. Write adjustment rules before emotions take over. If a mortgage is paid down, children become independent, emergency reserves are stronger, or responsibilities decline. Some cover may be reduced. If a child is born, income becomes concentrated, a parent needs care, or debt increases, the map may need more protection. If premiums rise until savings and necessary spending are squeezed, the family should review the structure. A good insurance plan is not a rule that says always buy more. It is a rule that says every premium should still match a live risk gap. A useful repair to the map is a role audit. Do not only ask who earns a salary. Ask whose income supports another person, whose unpaid care would need to be replaced with paid help, whose name is attached to debt, and who holds information the family would need during a claim. A stay-at-home caregiver may have no salary but still represent a major replacement cost. A high earner may need protection because others depend on that income, not because a high income automatically requires every possible policy. The second repair is a timeline audit. A risk does not stay the same size forever. When children are young, the period of responsibility is long. Early in a mortgage, the outstanding balance is higher. Near retirement, income replacement may become less important, while health and care uncertainty becomes more important. Place each major responsibility on a timeline. Mark when it begins, when it peaks, when it declines, and when premiums may become harder to carry. This keeps the family from being underprotected early and overburdened later. The third repair is a premium stress test. Imagine income falls by 20%. a medical bill arrives, or markets decline at the same time the premium is due. Can the household still pay without using debt or stopping necessary savings? If not, the protection may be too fragile. The right premium is not just the premium that can be paid this year. It is the premium that can be carried through a realistic household cycle, especially for policies whose costs may rise over time. The fourth repair is an execution checklist. A policy is less useful if nobody can find it or understand the claim path when the event happens. Keep a simple family sheet with company names, policy numbers, beneficiaries, claim triggers, key exclusions, advisor contact details, and document locations. This is not glamorous, but it turns protection into something the household can actually use. Many insurance plans fail not at the product level, but at the handoff and documentation level. The fifth repair is a recovery speed test for middle layer risks. If a loss drains reserves, but the household can rebuild them in 3 to 6 months, more retention may be reasonable. If a loss would take a year or more to recover from, or would start a chain of high-interest debt, more transfer may be needed. The same dollar amount can be small for one household and destabilizing for another. The map should measure recovery time, not just the name of the event. The sixth repair is to avoid using insurance as a substitute for budgeting. If the household has no spending plan, high-interest debt, or almost no emergency reserve, adding another premium may increase pressure instead of reducing risk. In that case, the sequence may be to stabilize cash flow, reduce dangerous debt, build a base reserve, and then close the largest protection gaps. Insurance transfers risk. It does not replace the need for liquidity and debt discipline. The seventh repair is to write disproof conditions. If you decide to retain a risk, the answer should change when reserves fall below the floor. Income becomes concentrated, a new care responsibility appears, or several non-deferrable expenses arrive in the same year. If a responsibility declines or assets grow enough to absorb a risk, the answer may also change in the other direction. Disproof conditions make the plan updatable instead of emotional.